Canada's economy grew in October, but just barely. Statistics Canada reported that a mix of good and not so good news today. Let's bring in Jeannie Lee, who's been combing through all those details. Jeannie, how much growth is barely any growth?
Well, the smallest increment that StatsCan reports, and that is 0.1% or 0.1%, Hannah. That was how much the gross domestic product grew in October, from September to October. Still, any growth at all does show some resilience given what's happened to the economy, and that it has been hit by a couple of shocks, and that would be high inflation and high interest rates. But then there's the urge to get back to normal. You can't deny that that is a very strong force. So let's take a look at where the areas of strength were, and they will not be any surprise to anyone who wants to get back to a more normal state of life. So plane travel rose 5.5% in just 1 month between September and October, and is actually back to pre-pandemic levels. Now, more people are getting out there. We saw that in a 14% jump in hotels and restaurant business, and going out for a game or a show, well, a surge of 24% in that type of live entertainment. But manufacturing, especially of durable goods, fell quite a bit. Possible sign that people are starting to feel the crunch, the cash crunch of high interest rates. They're paying more for everything else. They're not going to buy that fridge, for example.
And how might this influence the Bank of Canada's next move on interest rates? Everybody's watching.
Well, that's it. And, you know, we'll show you a graph to show you what the Bank of Canada is going to have to look at when it next decides on rates. And it's the overall big picture of what the economy has been doing. This is GDP growth in the last 5 years. And you'll see in the middle of that chart that big shock, the initial pandemic shock, and a quick rebound actually, and since then there has been steady growth, but at the end of that chart you'll see in recent months growth has been flattening out. And if that flatter trend continues, or worse, should it turn into shrinkage, well, that might actually turn into a recession, and the bank will have to hold rates steady because more rate hikes would obviously mean more economic pain. But if things stay pretty resilient and even pick up, then you might actually get more rate hikes, obviously, to control the potential inflation that would add to what's already high inflation. So those are the factors, but the other thing is time, because it takes at least 9 months for every interest rate hike to make itself felt in the economy, and we have had several series of hikes, so it's going to take at least a couple of more months, if not another 6 months, before we feel the full brunt of this campaign.
And Jeannie, we've seen deflation on the markets lately. How about today?
Less deflation, but then again, we are in basically the third week in a row of losses on the stock market. So the TSX Composite gaining back 106 points is not a huge move. Neither is a 63-point advance on the Dow Jones Index. The NASDAQ giving up another 24 points. This market has been especially hard hit by the growing pessimism of higher interest rates, caused by higher interest rates. Canadian dollar at 73.49 cents US, up about 1/4 cent. West Texas oil and Brent crude, both benchmarks much higher today because it's thought that Russia is going to now cut back its oil production in retaliation to all the countries who say we're not going to buy Russia's oil at any price higher than X, and whatever that cap is not pleasing Russia. So on and on this saga goes, and prices are up on the prospect of less supply from Russia. Hannah?
Thanks, Jeannie.
Okay.